Hi, everyone. Welcome to Comply and welcome to the session titled Tech Innovations and the Solve for Banks and FIs. My name is Dan Kwong, and I'm a managing partner of Bank Street Advisory and a senior advisor for McKinsey's banking practice. I also served 5 years as the senior advisor to Director Rich Cordray at the Consumer Financial Protection Bureau and led its fintech office, Project Catalyst. I'm very excited today to be here at Comply and have a conversation with 3 leading RegTech innovators about the problems their products are solving for banks and the financial institutions. So with that, let me first introduce our panelists. Brian Clark, founder and the CEO of Ascent RegTech. Robert Cruz, Vice President of the Information Governance at Smarsh. And last but not least, Karim Saleh, founder and the CEO of Fairplay. I'm going to ask a few questions to all the panelists so that the audience will have an understanding of the macro environment of the use of AI and automation in RegTech. Then I'm going to have an opportunity to ask each one of the panelists a specific question about their products and services so the audience will have a better understanding of what they're trying to do. So let's get started. Just as the pandemic has forced consumers to rapidly adopt digital channels for the first time, COVID-19 may propel faster adoption of automation and AI, especially in work arenas, according to McKinsey report. In its global survey of 800 senior executives in July 2020, 2/3 said that they were stepping up investments in automation and AI, either somewhat or significantly. Where are you seeing the greatest adoption of automation and AI? Robert, can you go first, please?
Sure. I mean, the lens we look through is around the tools that organizations are using to communicate and collaborate. So if you think about what we're doing right now on Zoom and also on Teams and Slack and on mobile applications, I mean, what's happening is that there's this greater heterogeneity of data. The problem is that for an organization that's regulated, they need to figure out where are the issues, where are the misbehaviors, and that's really difficult for an individual to be able to see through all this disparate information. So AI is actually a very good use case. This is a great use case for the application of AI, just to understand what individuals are doing, what are they saying, who are they interacting with. So the communication and collaboration around all this new forms of digital data is really one of the things that's driving AI from what we've seen from our clients.
Great, great perspective. Brian?
Yeah, I think that what Robert said is really on point. When you have industries that have sufficiently discrete, and I mean discrete mathematically, sets of data where it's focused, you can start to automate that, whether that looks like knowledge going forward will increasingly be done by algorithms and machines. I think taking a step back on how that applies, COVID exposed a lot of operational gaps this year. It's really accelerated the need for digital adoption across industries. Compliance, as we know, is no longer a back office cost sector. It's really business leaders are looking for proactive solutions, ways to take not just a risk-based approach, but kind of a holistic approach to solving this problem. What that means when you have volumes of data that are, again, focused, like we were talking about, is you have to use automation, you have to use machines. And in this case, those digital machines are AI, they're algorithms. The industry has figured out how to automate workflows. But now we're capable of automating knowledge, obviously something that we've talked about previously. This drastically reduces regulatory administrative work, and it can free people up to focus on decision-making, strategy, actual control testing, things like that. It also enables businesses to focus on their core offerings, right? To grow the business without adding additional resourcing. That really is a bit more of a cost center. Financial services is very competitive, and the only advantage folks will have is how adapt. That's where automation is really going to make a big difference.
Great. Karim, do you see anything different?
Yeah, thanks, Dan. From my vantage point, some of the fastest and the areas that are kind of most ripe for the adoption of AI has been in consumer loan underwriting and fair lending compliance. consumer loan underwriting in particular, because the effect of the pandemic has been so uneven across geographies and employment sectors, that the risk of non-linear relationships is heightened in this kind of environment. And so being able to use advanced analytics that can capture those non-linearities is really critical to being able to underwrite in a period of, frankly, tremendous uncertainty, where government stimulus programs have temporarily increased the ability of some consumers to manage their debts, and prohibitions on negative credit reporting have made it hard to discern who's creditworthy and who's not. So we're seeing at the same time, compliance obligations that were often done kind of using manual processes and done on site have been needed to be performed kind of remotely, and using better tools so that they can be done more quickly, more rigorously, more cost effectively in a work from home environment. So I would say that those are kind of the two areas where I've seen the biggest acceleration in AI adoption: is consumer credit loan underwriting and fair lending compliance.
Great. Since this is a compliance conference, we're definitely going to talk about regulations a lot. So a recent KPMG survey suggests that executives are now concerned about investments in AI moving too fast. In fact, most of the survey respondents cited a definitive need for increased AI regulation. So Karim, since I have you just talking about the regulation, do you have any thoughts on regulating AI and what it would mean for RegTech industry?
Yeah, so in financial services, I would argue that we actually have a pretty good regime for regulating AI in the form of, for example, the model risk management guidance that applies to supervised entities. I think that there will be a question under the new administration whether that model risk management guidance gets extended to unsupervised entities like fintechs and other non-bank lenders. But the regime itself, which requires kind of the robust testing and validation and monitoring and governance of algorithms is itself, I think, pretty strong. It may need to be updated in a few places for the AI era to reflect things like multivariate interactions, which AI systems rely upon to make decisions. I agree with you, Dan, that a lot of institutions are rethinking their AI deployments. I saw a headline, I think, in the MIT Technology Review a few weeks ago, saying something that like 50% of all AI deployments fail to achieve the business objectives that were set out for them when they were initially contemplated. I think that having a more robust AI governance and making sure that the existing regulatory regime around model governance and for supervised entities being extended to some of the other players who touch parts of a credit transaction is something we're likely to see, and probably substantively the right thing to do.
Great. Robert, what's your take?
I think there's a couple of different dynamics here. The first of which is, if you look at some of the apprehension that firms have regarding the adoption of AI, in particular around communications, how they deal with record keeping and, written supervisory procedures and the like, I think there's some concern regarding the transparency of AI and making sure that they can defend and explain exactly what the algorithms are doing to a regulator. So I think that there's concerns that rise in that area where I think firms are becoming more comfortable over time, at least having an understanding at the high level of how decisions are being made. But I think what's driving things in the opposite direction and toward greater adoption faster is that if you look at the SEC and FINRA, both have said that they are adopting AI in their examination process. That's the way that they are conducting exams. And they are encouraging firms to use that same set of advanced technologies in their own supervisory protocols. So they are pushing for greater adoption because this is what they're doing themselves. And they've recognized that this is the easiest way or the most effective way for them to be able to spot some of these risks. And it's really creating a signal for the industry that they need to be moving faster in their own adoption.
And Brian, what are your thoughts?
I love what Karim said about the questions about really the commercial element, not just the regulatory element, because I can't help but look at these sorts of survey results and wonder if the concern is on competitive marketplaces, that it's moving too fast, it's difficult to understand where your investments are placed and what those returns are going to be. But I think on the regulatory side, the model risk management practices, as was already noted, are already pretty effective in financial services. We see them adopted globally in form of ECB's regulations on models. I think traditionally, those have been quantitative in nature. And what we're seeing with AI and NLP is a bit more of adoption of model risk management around qualitative analysis, right? Word-based analysis, prediction-based outcomes, depending on the type of algorithms you're using. So the regulation will come. In the meantime, firms really need to feel more confident about those investments. And I think what we're talking about with regulation is ensuring fidelity in the outcome and ensuring trust in the process. And that's what we just don't have yet. And that's purely because it's a bit nascent in adoption. Tech providers should have rigorous model risk management practices, as we've noted. They should be able to explain why they're using AI. A lot of times it becomes a buzzword and it's an overinvestment when in reality, a simple algorithm or a transformation is all that's necessary. So it really you have to make sure that it has the business value. This will increase trust in the actual quantitative and qualitative outcomes, not just the commercial investment. And then lastly, AI really should not be a black box of any kind. The algorithm itself that's going to be operating, you need to be able to see the input and the output. Without that, without the ability to verify that output, without the transparency in the process, it breaks down that trust. And it's going to be critical going forward. Regulators themselves, as was already mentioned, are adopting RegTech, AI, and they're starting to call on firms to make the same sorts of investments. So the message is loud and clear. And I think that regulation of AI itself is going to come regardless, and it's up to us to shepherd it in the right direction until then.
Great. So now we have a new administration, and we're going to have new sheriffs in town. And this new administration obviously is very focusing on consumer protections and investor protections as well. So, so where do you think compliance changes could come more swiftly? Brian, you want to go first?
Sure. Yeah, I think that with any administration change at any level, you have delta. And we're all in the business of mitigating that delta, right? How do you mitigate the risk of those changes up and down from statutes and laws to regulations to the implementation of all of those items into your programs and keeping up with that on a regular basis? So I think you're going to have a change cost, as you always do. But in particular, I think the administration is going to place additional emphasis and scrutiny on the outcomes, on the line-by-line compliance, on the nitty-gritty that we've been talking about here today. In banking and financial services, as we all know, it's highly regulated, but I think we're going to see a bit of an uptick in that, number one. Number two, as businesses become more regional, national, global, it's much easier to enter a jurisdiction in the digital age. That means a lot more regulatory arbitrage. And so you're going to see a little bit of this approach of complying with the most restricted regime in which you're active. And I think that's going to have a pretty profound impact on how the administration writes rules and how we look already across the globe for how those rules are written.
Kareem, what do you think?
Yeah, I mean, from my perspective, I think if you look at the statements out of the interim director at the CFPB and you kind of look at the pedigree of the nominee for the CFPB, I tend to think that fair lending enforcement is going to be back in a very big way. Some folks may recall that under President Obama, fair lending enforcement was a huge priority. Ally paid a $98 million fine. Citi paid a $25 million fine. Toyota and Honda paid fines in the tens of millions of dollars. All of that went to zero under the previous administration. And so I think it's highly likely that the fair lending enforcement pendulum is going to swing back in the direction of kind of more robust, more rigorous examinations, probably fines for violations. And I think that, you know, as issues of economic inequality rise on the national agenda, that the kind of drumbeat for fairness in financial services is only going to get stronger.
And Robert, do you see similar changes in the broker-dealer space?
Yeah, I think there's a couple of things that have already been highlighted in the first couple of months of this year. And if you look at the FINRA exam priorities, which were published at the beginning of February, you know, clearly there's going to be a change in cadence, direction, frequency, severity of enforcement and penalties. But you know, the exam letter calls out things like outside business activities. And anti-money laundering practice, things that are going on now on this increased set of digital communication tools. So it's really calling out the need for firms to be looking at all these dark corners of information, making sure that the existing regulations are things that you can look for violations through all these ways that individuals are interacting. Take the Roaring Kitty case. This happened on Reddit. It could have happened on Discord, House Party, Marco Polo, Clubhouse, anywhere. So you see a lot of these things happening now in places that are harder for firms to be able to monitor. But I think that's where the exam-letter priorities kind of indicate your compliance perimeter needs to be broad enough to be able to see where individuals are interacting. I think that's an important message for customers to think about.
Great. So we just continue with you, Robert. So Smarsh works a lot in the broker-dealer space, and the SEC just released the updated SEC exam priorities that, quote, will focus on the implementation and the integration of RegTech in firms, end quote. So what does Smarsh do to help broker-dealers meet compliance obligations?
Yeah, it's a great question. So Smarsh basically is in the business of helping companies to leverage the communication channels of their choice, the ways that your clients want to interact. If you're allowing your registered reps to communicate through Slack or Teams or through WeChat or WhatsApp, we provide the mechanism so that that communication can be captured, it can be reviewed, and you can look for policy violations. So that whole record-keeping requirement really now is broadened because for every firm, your visibility is limited. You have less of an ability to see what are employee behaviors looking like today, where are they happening. So being able to see where there may be regulatory issues that firms need to be paying attention to, or internally policy violations that may be in the form of harassment or other activities happening in the digital universe. We help companies to spot the red flags so they can take action before the regulators, so they can be more proactive in identification and mitigation of risk. So that really is applicable across all sectors of financial, but in particular around wealth management.
Great. Switching to Brian. So Ascend RegTech is basically a knowledge platform that identifies the obligations and the rule changes that apply specifically to a business. So what have been the biggest hurdles your customers face this year, and what do you see ahead in 2021?
Great question. As you noted, Ascend created a new type of technology called regulatory knowledge automation. This really changes how people comply. What we've seen over the last year are the challenges that we all have to be disintermediated from our physical offices, to be in different locations and needing those digital single sources of truth. What that efficiencies, saving time, saving money, because you don't have the same kind of co-located brain trust working on the same problems. What we see ahead in 2021 and beyond is really a new paradigm for compliance. And that means breaking the cost-risk trade-off. Usually more cost meant less risk. And technology, as any of us, from our Econ 101 classes, as we know, that increases productivity. And in our case, it decreases risk and decreases cost. So you can spend less and reduce that. It's a pretty obviously novel concept. That's what we hope technology does for us. Now, the key here is that change can be scary. So using technology in a space that usually was very manual is something that can be difficult at first, but it's creating massive opportunities for firms. That includes folks in risk, compliance, audit. And there's one thing that we've seen over the last year that I'll say even was a bit of a surprise to me, and that's the speed of implementation when you use AI. And that's real AI, not the type of AI where you need to review everything, right? Because that's not AI, that's just search glorified and marketed. I mean AI where it's actually going to produce the outputs. It's going to automate the knowledge work that you were doing. And of course, that's what we do at Ascend. And we've seen that really, really rapidly impact how quickly people can get up to speed, get systems installed. We're talking hours, not months. It's that big of a shift. We're talking implementations, full implementations in a day or two rather than a 12-month project. That allows clients to get value much faster, and in today's environment is really a necessity to remain competitive.
Great. So let's turn to Kareem. You're the last but not the least here. In your earlier comments, you mentioned the statements from the interim director of the CFPB, Dave Weigel, and also you mentioned the credentials of the nominee of the Bureau, Rohit Chopra. And you believe there has been a renewed focus on fair lending, and the AI continues to be scrutinized in the process. which is very obvious. So fair play is probably the newest kid on the block, but you are a veteran in the AI space. I've known you for a long time. So you mentioned fair play is a fairness as a service, and tell us about how you are taking a different approach to AI and the algorithm to capture frequently overlooked borrowers and optimize both profitability and the fairness for lenders.
Yeah, thanks. So we call Fair Play the world's first fairness as a service company. Our conviction is that as algorithms make higher and higher stakes decisions about people's lives, like will they get a job, will they get a loan, will they get insurance coverage for a kidney transplant, that the institutions making those decisions are going to need to be able to embed fairness considerations into their automated decision-making systems in a quick, rigorous, cost-effective way. And so we've decided to go to market in consumer lending, where there is a fairness regime, the fair lending compliance regime, and where frankly the fairness regime has been a bit broken. Consumer lenders, especially unsupervised ones, for those in the audience who are unfamiliar, have fair lending compliance obligations to make sure that they're doing right by historically disadvantaged groups like people of color and women. And traditionally, fair lending compliance has been manual, time-consuming, expensive, and doesn't actually result in fairer lending practices. Lenders are typically hiring costly outside consultants and lawyers, or maybe they use internal quants to assess their portfolios for disparities. And generally, these parties are spending their time writing creative legal justifications that attempt to justify disparities rather than actually remediate them, which leaves institutions with residual enforcement risk. And as I was saying earlier, like maybe you could get away with lax fair lending compliance under the previous administration. But I think that the new Biden administration has signaled their intention to take fair lending compliance and fair lending enforcement and issues of racial equity a top priority. So our message to lenders is that it's time to get bring your fair lending compliance into the 21st century. You need fair lending compliance that is automated, rigorous, cost-effective, and that actually enhances the fairness of your marketing, underwriting, and collections practices, rather than merely justifying disparities. We have built a platform that allows any compliance officer to use cutting-edge AI techniques like generalized adversarial networks or kernel methods or other algorithms I won't bore the audience with, to quickly assess their marketing, collections, underwriting, and pricing models for bias, to search for less discriminatory alternative models that optimize for fairness in addition to profitability, and also to run second look processes on your decline populations so that lenders can make sure that they didn't say no to borrowers just on the other side of their approval cutoff thresholds that actually resemble good borrowers on certain dimensions. What's cool about our platform is that it also generates all of the documentation and reporting that lenders need to give internal audit teams and regulators hard evidence of their commitment to rigorous fairness practices. And our tools also generate actionable adverse action reason codes so that lenders can give denied borrowers a roadmap to being approved in the future. That is not only kind of substantively the right thing to do for those individuals, but it also enhances the ROI of lenders' advertising campaigns by capturing good applicants you've already marketed to. So to recap, our message is that as economic inequality issues rise up the national agenda, and with a much more aggressive enforcement environment on the horizon, we think lenders who bring AI to bear on their fair lending compliance will have an economic, regulatory, and reputational edge.
Great, thank you very much. So this is the end of the session. I would like to thank Comply and also thank our panelists, Brian Clark, Robert Cruz, and Kareem Saleh. Thank you.